Anybody who buys gold based on war needs to have their head turned around. What silver's done, it was $56 in November, and yeah, right now it was 73 yesterday in a pullback. The only thing silver's done since then was after rallying back up to 90 plus, it sold off instead of going up like people think it should. And even some of the big banks, we've been watching half a dozen of them since October, and three of the biggies have broken long-term momentum structures. Not so apparent on the price chart. That doesn't mean they're going to crash. Now, gold, like any market, will inhale and exhale. But basically, it's an ongoing process of discounting the ongoing degradation. It's going to take a lot to cut the demand side because the solar demand for silver is extraordinary. And, China produces most of the solar cells, particularly as oil goes up. And by the way, oil going up does not hurt the monetary metals. But no, I don't think oil is going to cause a recession. We think there's a recession or worse coming anyway, and it's a stock market bubble. Eightfold means 8,000 plus gold.
Last time I had you on the show was November of last year when silver was in the $40 to $50 range, and you said silver was headed to $100 plus, and that call proved to be very accurate. Of course, that begs the question, now that silver is back at $70, we've been on quite a roller coaster since then. Do you see us going back to triple digits potentially at some point this year?
Oh yeah, I think he'd go to medium level triple digits, like 300 to 500. I know I'm a lunatic. Okay, there's reasons for that, technical and fundamental. But our focus is obviously the long-term technical situation, and it sounds unusual for a market to do something like that, but it's not. There have been instances in the past at other markets, which we've shown in our reports, like in copper in 2005 and 6, and lead in 2007. And I could find tons of others where suddenly a market that's been asleep for decades in a little range says, hey, no more. Boom. And it triples, quadruples in price in a matter of several quarters. And you know what? And it stays up there in a new reality. And I think silver's headed for that.
A move from $70 to $300 sounds extreme, but history shows markets don't move linearly. They break structure. As Michael Oliver points out here, the real signal isn't price. It's the transition from a decades-long range into expansion, something commodities like copper showed in 2005 to 2006. But what's not said is how rare timing these breakouts is. Most investors either enter too early or exit too soon during volatility spikes. A 4 to 5x move requires not just momentum, but sustained liquidity and narrative alignment, which isn't guaranteed in current macro conditions. Next, Michael Oliver discusses why recent price action may be misleading investors.
Now, why do you think both gold and silver have taken such a hit since the Iran war started? We can clearly see there's been a correlation between expectations of the war continuing and precious metals prices dropping, most notably recently when Trump gave a speech where he basically said the Strait of Hormuz won't be opened by the US and the war is going to continue, which caused the metals to tank. Is this concept of war being a tailwind for precious metals misguided? And how do you expect both gold and silver to react if the war drags on? If we see this drag on for months, years, does that change your call for $300 to $500 silver?
No. I consider the war essentially irrelevant to what the metals are doing and have been doing for years. Okay, so anybody who buys gold based on war needs to have their head turned around. I mean, you go back and study the archives. We'll even go back to the Ukraine situation. When was that? March of 2022. You know where gold was then? For several times it had been up over 2,000, after having already doubled from 1,000 in 2015. And in 2022, it was up over 2,000 again, and they bagged it and it went down to 1613 by September of that year, March to September. But that was the war started. As soon as the war started, it went down. Commodities went down. Oil went down. Okay, all the things you'd expect to go up during war, false assumption. And this situation is it's not going to drag on for years. Trump may just pull out because he doesn't want to hurt the stock market. He's already done a lot of damage. Whatever, but that's really, it's a nuisance headline. because it distracts people from the underlying reality of why gold and silver advance in the first place. And the argument for that, monetary argument, silver also has an industrial situation, is simply the degradation of the money units. The yen, the euro, the pound, the dollar, the quantity of those money units, like the dollar, and you look at an M2 chart, go to the Federal Reserve site of St. Louis, look at all their lovely charts.
The biggest misconception in markets is that geopolitical fear automatically drives gold higher. And this clip quietly dismantles that belief. As Michael Oliver points out here, gold actually fell sharply after the March 2022 Ukraine war began, dropping from over $2,000 to $1,600 ton of thermal within months. What's not being said is that markets price expectations before events, not during them, meaning retail investors often react too late to headlines. War becomes noise while liquidity and money supply quietly dictate direction. This is where most portfolios get misaligned, chasing narratives instead of tracking capital flows. Next, Michael Oliver unravels the real driver behind long-term metal trends.
And the M2 chart's like a parabolic, lovely place to be. It looks like a stock market going into blow-off. Okay. And what it does is every decade, basically, if you do the math on it, you can select a point on that chart, like January of 1960, January of 70, and then measure the growth. It's about 80% a decade increase in the supply of money. So no wonder when I was a kid, a loaf of bread was 20 cents. I've said this before. Your granddad, when he built the house, cost $4,500. Your father, $45,000, and now if you want to build a median home price, it's $450,000. Degradation of the money unit. Okay, now gold, like any market, will inhale and exhale, but basically it's an ongoing process of discounting the ongoing degradation. Now we have a unique situation with driving the monetary metals, and that is they can smell, they know that there are big troubles out there. Government debt. Japan is in a bond crisis. We all know about that. Think, well, that's Japan. Well, yeah, right. It's here too. Our bond market is sick as heck. Even the Fed's been buying it since November. Well, the central government can't afford to have their bonds even be perceived as not being a place to be. And so they've been in printing money buying the damn thing. The Fed has. They announced it in November, head of the Fed of New York. Williams said the Fed's going to start buying bonds. His excuse was to provide liquidity. Okay. Anyway, if you look what bonds have done since then, they've gone down in price. Yields have stayed high and gone high. And they're not controlling the long end of the debt market, which is choking, commercial real estate, consumer credit crisis has been mentioned lately, finally. And MSA, we follow, instead of looking at AI so closely, which will lead the way down ultimately, we're out watching the financials. They don't look good. The financials are anemic compared to the stock market. In fact, if you take XLF, the financial sector ETF, which is full of banks, brokers, insurance companies, credit card companies, and measure it versus the S&P, it's at a multi-decade low in terms of relative pricing status.
An 80% increase in money supply per decade isn't inflation. It's structural currency erosion most investors underestimate. As Michael Oliver points out here, M2 growth has compounded for decades, quietly repricing everything from housing to commodities, without most people realizing the scale. But the deeper issue is the bond market instability. Yields rising, despite Fed intervention since November, signals loss of control, not stability. When financials lag the S&P to multi-decade lows, it's often a warning sign, not a coincidence. That disconnect is where smart money starts repositioning before broader market recognition. Next, Michael Oliver discusses what this breakdown means for banks and systemic risk.
Relative performance. Something's wrong over there. And even some of the big banks, we've been watching half dozen of them since October, and 3 of the biggies have broken long-term momentum structures. Not so apparent on the price chart. It doesn't mean they're going to crash, nothing like that. I'm just saying that they've broken the kind of factors that we at MSA regard as, negative, big negative. So there's something behind that. And gold knows that. The central bank knows it too.
And going back to the $300 to $500 silver call, is it momentum mainly that is leading you to this conclusion? Are there fundamental reasons behind it? Is it mainly the charts that you're creating, that you release in momentum
I'm
structural
going to throw out a
analysis?
bunch of ideas to answer that,
Yeah.
because it's a bunch, and they don't correlate to each other. They just happen to sing the same song. Okay, if you look at a gold chart going back to when they made it legal again in 1975, we've had that was a peak in gold. It had gone from $35 to 200 before it was legalized.
When bank stocks quietly break momentum while headlines stay calm, that's usually where real risk begins to build. As Michael Oliver points out here, multiple major banks have already slipped below long-term structural signals since October, even if price charts haven't fully reflected it yet. What's not being said is that markets often crack internally before they collapse externally, and financial sector weakness historically leads broader downturns. Investors focused only on index highs miss this divergence completely. This is less about panic and more about early stage deterioration beneath the surface. Next, Michael Oliver talks about how gold's historical cycles frame what could come next.
Then it legalized at 200. It dropped in 1976 to just above 100, 50% drop. Between that mid-1976 and 1980, it went up eightfold. Take that bear low price and multiply it times 8. It went up to $850, okay? And then it leveled off for decades. It made a low in 2001, 2002, around 260. And went from 260 to 1920 by 2011. So 10-year bull market, different age, but also an eightfold move, okay? Then you go to the recent low, the bear low in 2015, 1050. Well, let's say we're going to just match what the other two bull markets did. Eightfold means 8,000 plus gold, just to equal the dimensions of the last one. In fact, what we find interesting, and we've been saying that for a year or so, that's not a target, by the way. That's just saying, hey, just to match the prior two, do it again, JP Morgan came out with a number like above 1900 as a fundamental target. That was interesting. Above 9,000. So even above the 8,000 level. So, but silver during all that time, 50 years, was capped at 50, 50, 50. Yet gold would blast out the highs. Silver would go up with gold, but it wouldn't get past the 50 level. Well, that changed. And we anticipated that it would. 2024, we said silver at $26, primary buy. And then in June 25, silver pushing toward 35, we said accelerations to begin. And our last buy signal, and it will be our last primary, was November last year when silver was 56. Because at that point, silver broke out versus gold on a relative performance basis, a technical basis, saying, hey, I'm going to beat you. I've been lagging you. I'm going to beat you now. And since then, well, you can see what silver's done. It was $56 in November.
An eightfold gold cycle sounds mathematical, but markets rarely repeat clean patterns without distortion. As Michael Oliver points out here, prior bull runs from 1976 to 1980 and 2001 to 2011 both delivered roughly 8x moves, implying a theoretical $8,000 to $9,000 range today. What's not being emphasized is that those cycles were driven by unique macro shocks, Volcker-era inflation and post-dot-com liquidity, conditions that don't perfectly mirror today's environment. Silver's breakout above its 50-year ceiling is significant, but sustaining leadership requires continued capital rotation, not just historical symmetry. Next, Michael Oliver discusses why recent volatility may be misinterpreted as weakness.
Yeah, right now it was 73 on Thursday, yesterday, in a pullback. But as far as the war news, again, that occurred in early March, and silver was above 90 then. But the real collapse in silver came one day at the very end of January, where you dropped down into the 60s by the first trading day of February. So in a day and a half drop, you had the full drop. The only thing silver's done since then was after rallying back up to 90 plus early this month. Then the war hit, you're right. It sold off instead of going up like people think it should, which it doesn't. We don't follow war. War is not a fundamental for gold and silver. And it came down and nipped out 2 weeks ago. We took out the February low, which is for silver like 66 something. We get down to 61.20 and immediately rocketed back up into the mid 70s. Like, ho, 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 fooled you.
The sharpest move in silver this year didn't come from war headlines. It came from a single liquidity shock in late January. As Michael Oliver points out here, the drop from the 90s into the 60s happened in just a day and a half, which signals forced selling or positioning unwinds, not fundamentals. What's rarely acknowledged is how often retail investors misread these events as trend reversals, when they're actually structural shakeouts. The quick reclaim into the 70s suggests underlying demand hasn't disappeared, only weaker hands have. Next, Michael Oliver unravels how gold mirrored this exact pattern beneath the surface.
Okay, take it out to February low. Gold did the same thing. Got down to February low was $4,223, I think. We went down and swept that, got to 4,100. And 2 hours later, we'd rallied hundreds of dollars after taking out that low. And gold's now, we've hit 48,000 last week, 4,800, last week. And I think we settled about 47, something like that. Anyway, but war is not an issue. And most of the damage, the war sell-off was merely within the context of the already drop that had occurred in late January, if you get my point.
When gold wipes out a key level and reverses within hours, it's rarely random. It's a liquidity event exposing positioning imbalances. As Michael Oliver points out here, the sweep below $4,223 down to $4,100, followed by a rapid rebound, suggests stop-loss cascades rather than genuine bearish conviction. What's not being highlighted is how these false breaks often trap late sellers, while institutions quietly accumulate. The fact that prices quickly return toward $4,700 to $4,800 signals resilience, not weakness, especially in a fragile macro backdrop. Next, Michael Oliver talks about why war narratives keep misleading investors.
Yeah, now what about the narrative out there that this war is going to lead to a devastating global recession? It's hard to figure out what's true and what's not, especially with social media being so hyperbolic these days. But a number of analysts have come out and say we could be facing one of the most serious energy crises that we've ever seen in modern history, food shortages, all these sorts of things. We have seen certain countries already in pretty dire straits, Pakistan, Philippines, Thailand, Australia, etc. What are your thoughts there? Do you think that's being over-exaggerated? Is that real? And could that impact the demand side for silver ultimately due to reduced industrial demand, should such a scenario play out?
Well, it's going to take a lot to cut the demand side because the solar demand for silver is extraordinary. And, China produces most of the solar cells and photovoltaic cells that go in the solar panels, like 80-90% of global production of that. And it's in great demand. Particularly as oil goes up. And by the way, oil going up does not hurt the monetary metals. There have been plenty of times when oil has exploded and monetary metals have exploded. During the recession as well, okay? Late 70s, okay, people say, well, if you have higher oil prices, that is going to cause a recession, therefore that'll cause gold and silver to go down. No, the central banks go ape when you enter a recession.
The recession narrative tied to energy shocks sounds logical, but markets don't always follow linear cause and effect thinking. As Michael Oliver points out here, even during past oil spikes like the late 1970s, both energy and precious metals surged together despite economic stress. What's often ignored is that central bank reactions, rate cuts, liquidity injections can override demand destruction narratives entirely. Solar demand alone, with China controlling up to 80 to 90% of production, creates a structural flaw under silver that recession fears may not easily break. Next, Michael Oliver discusses where capital actually flows during crises.
And the money never flows to where they want it to go, which is the stock market bubble that is already breaking, and therefore the bad data points that they're trying to save us from. The money flows elsewhere, and it's almost always gold and silver. Used to be T-bonds too, not anymore. So you're left with one alternative right now. So that's as far as the global issue of oil prices. Oil is still cheap at 100 plus. Look at its old highs. Go back, 2008, 2022, and so forth. 150, 140, 130, that kind of thing. So gold at 110 is just sort of getting up to the old nominal price highs. Remember the degradation of the money unit. If you degrade the money unit by 80% a decade in terms of increasing its quantity over time, then the price is something that decades ago, if you factored in the monetary degradation, should be quite a bit higher just to reflect the decay and piece of paper you're using to measure it by. Gold does that, and oil has done that. Silver is now finally doing that. But no, I don't think oil is going to cause a recession. We think there's a recession or worse coming anyway. And we think that's been built into the factors. And it's a stock market bubble that we're sitting on and looking at.
Capital doesn't disappear in a downturn. It rotates, and right now that rotation may already be underway beneath the surface. As Michael Oliver points out here, traditional safe havens like T-bonds are no longer absorbing flows the way they once did, leaving gold and silver as primary alternatives. What's rarely discussed is how this shift reflects declining trust in sovereign debt markets, especially with yields staying elevated despite intervention. If equities are indeed in a late-stage bubble, the reallocation could accelerate quickly, catching passive investors off guard,